All right. Good morning, everybody. It's gonna be a kind of a quiet one. There's really not a whole lot on the table, right? So we call it like going quietly into the close. All the market has to do this week is hold the line. So we're red across the screen around the world. Hong Kong is down the most, which really isn't saying all that much because it's only down 1%. And all four of the US markets are the closest to zero. If we look at the most impactful economic events for today, 10 a.m., 11 a.m., and 3 o'clock. If we kind of step back and look at everything on the table today, we can see it's a pretty good sized list. Now I just said everything, but I continue to get asked what I mean by watch the clock. There's nothing funny about that, right? I'm not trying to be subtle. I'm seriously saying watch the clock. The government's lazy. It's predictable. It's going to put out data on a 30-minute and a 1-hour time frame. This is not all the data that's coming out today. I guarantee you there's 5 times more than this coming out. The thing is, a lot of times it's small data. It's data that isn't even glamorous and sexy enough to hit the wire. So while it could move markets, we don't want to try to spend all day long hunting down every little nuanced thing that could come out. The thing about those little nuanced things is sometimes they can move a market too. And we can't try predicting which ones will and which ones won't. But we can really easily watch the clock. And if we got the market coming down into a major support or moving up into a major resistance, and we're really close to a new hour or a new half hour, watch the clock, because that volume is going to come in, and it very likely could be the period in the day where everything changes. It's where they pull the rug and start burning all the premium out, or it's where they decide we're not going to run it back up, and they just run it to the downside another 1 to 1.5%. So watch the clock. This is not all of the events. There's always more. The dollar is still really high. It's talking here where it says it pulled back a little bit, but it's in, some pretty high territory. The thing is, if we go in and we were to look at some technical analysis, it is in a resistance point. It's at this point where we really don't think it's going to get much higher than that. So we'd want to think of it in zones. If it gets above we used to say if it gets above 103, it's a level of concern. Things changed along the way, and 103 was no longer the level. Then it was 105. Now it's 106. So if it gets above 106, then we're going to be concerned. And that's only the number right now. That can change. The reason it changes is because over time, if we slow grind our way up to 6, then 106 won't be a problem anymore. It'll be some other number. But if we go from 104.5 and straight shot right through 106, oh, that's a problem. That we're going to feel that. So that's why the number keeps changing. It's not that we just keep moving the goalpost. It's at the time that we put a line in the sand, we're talking about if we go from where we are to that number in a day, which the dollar can do, it's going to cause some problems. But if we just slow grind to those levels, then we'll have to have another benchmark farther out. I'm still trying to put together the consistent theme or narrative out of the Fed yesterday. And it wasn't as consistent as I would have anticipated. They're they're doing a terrible job of speaking from the same book. Some Fed speakers said we're there. We just need to hold out, hold it here, and let our work kind of bleed through the system. And other Fed speakers says, no, we're not done yet. We're gonna have to raise some more. We want to kill it until it's dead. So not the consistent message we were looking for, but I'm gonna parse through more of the data over the weekend. That sounds like a fun weekend, right? Nerd. US dollar Japan continues its march to the upside. We are on a weekly chart, so we pulled back a little bit. The doji with my white line here is last week. And if you look at these moving averages, MBO, right? Most bullish offer. I mean, look at that. That's just textbook perfect. This thing is a runaway machine, the juggernaut. And body in motion stays in motion until something goes in here and changes this thing's course. Then the course is set. We will get intervention at 152. And I wouldn't take Bank of Japan at their word. They might say 152 and then come in at 150, like a SWAT team. So who knows if they're going to intervene early or not. But intervention is in the cards without a doubt. That's coming because this isn't stopping. And we tie that in with, this runaway bullish move in DXY. Something's got to give. Eight 30, 10 o'clock, 1 o'clock. If we go out to this weekly, oh yeah, FSLR is up in the pre-market. That's just random. Just throw that at you real quick. So if we go out to this weekly here, we can see how we're holding above that 20. And we've got the 10 just slightly overhead this morning. That's the 10 week and the 20 week. And we're sitting inside of last week's candle. That's the only thing the market has to do this week is just hold the line. All right. Now, in analysis point of view, the fact that we're even inside of last week's range at the end of this week isn't exactly, the picture of health. Closing below 50% of last week's candle is certainly not a picture of momentum. And we haven't been in a trend, so we don't even have to worry about, do we have a picture of trend? But it's unhealthy and there's no momentum. And so we could really come back down to that 43.82 and retest that 20 period moving average. There's nothing right now that suggests that we won't. And we don't want to try to trade with an assumption, right? This really is a head and shoulders pattern, as ugly as it may appear, but it's a weekly head and shoulders. Now, some head and shoulders are really wide. They can span for years in their development on a weekly chart. This head and shoulders is a really compact, narrow head and shoulders. So we wouldn't look at this and say, well, it's a weekly, it'll take a year to unfold. No, it could take a month for it to unfold, and a month isn't really all that long at all. All we would need is a neckline break, and that would be that 43.82-ish area. To kind of identify, well, how far down could we go? We would just measure from the head down to the neckline break and project that lower. Just a casual visual off the cuff napkin math point would be that 50-period moving average down there, that 41.28. I'm not saying we're going to 41.28, but there are a lot of analysts with 20 and 30 years experience that are calling for 4,000, 4,100, 4,150. Just kind of keep that in mind, right? That's the projections. And it's not necessarily just because of what the chart looks like here. It's also the discussion with US dollar Japan, interest rates, CPI on deck, right? All these different bigger picture themes. My argument has been that we would see 4,600 before we would see 4,300. But, or we'd see 46 before we'd see 41. So the market needs to hold this last week's candle, needs to hold inside of that. If we continue this move to the downside today, it's not a big deal. As long as we hold above that cog line, 44.12, 44.11, right around in there. If it does that, then there's still the potential for this to move up. Otherwise, we break lower than last week's low, and we're destined to go to the green line. We're very likely also going to go to this last pivot point, 43.50. And if we break that, we got a gap to close down here, 43.04. That will become a magnet, and we'll just gravitate to it. Looking at the volume this morning, we're well within our normal boundaries. So the volume's not overly heavy, but there is hedging in the front end. So they're concerned about something that's on the deck, and that hedging activity can be identified because we have a market maker move. So we have a little bit of divergent information here. Generally, if there's something on deck that makes them concerned, say like a non-farm payrolls report or a CPI, then we would see low volume and a market maker move, because they would be sitting out of the futures play, which would give us the low volume, but they would be heavily trading in the futures options on the front end, which would give us the market maker move. But that's not what we have this morning. We have the regular volume that we would normally get, somewhere around 100. And we have a market maker move. Now, volume is just volume. It doesn't say that it was bought or sold, and it takes two parties. So it really doesn't matter if it was bought, there was still somebody selling, and vice versa. Unless we get into volume deltas and start, asking questions about, was it initiated AA and BB, then volume is just volume. And this is cumulative volume, no less. So, or even a step removed from that kind of activity. It's just action that has been taking place. Somebody's been participating in the market. But it looks like they're waiting on something. Funny thing is, that was what we started to talk about yesterday afternoon, that this market is on pause and it's waiting for something. But what is the something? Because we look at the economic data on the table, and there's nothing in there big enough to warrant this kind of behavior. So it's like, okay, well then what's the issue? What are they waiting for? Don't know. But the great way about approaching the markets from this way is we don't have to know. As long as we can recognize that these pieces of the puzzle are there, then even if we don't know what the data point is, we can at least recognize the behavior, so that we have the expectation that we'll sell into strength, we'll buy into weakness, we'll play the range until we no longer have the range, and that the range is expected to expand in a megaphone pattern until we finally break out. So at least it's actionable intelligence, right? It's not just some theory or concept. So now that we've kind of got that done, we can just get it out of the way. If we think about how far could we move today, first of all, yesterday did end up being an MDP, right? Remember we talked about that, how it was looking to be an MDP, but we didn't know if it would hold. Well, it held. That gives us an MDP for every day this week. If we don't look at Monday, which we wouldn't anyways, because Monday was tied into Tuesday and we still didn't hit that daily pivot. So that's 3 days now in a row. For day 4 today, we've hit it. We're tangled up in that thing significantly, but that's because we quit falling yesterday, right? If we look at how the floor pivot moves down with us each day, well, yesterday when we rallied back up towards that floor pivot, the next pivot that got formed, we were right into the thick of it right at the Globex Open last night. So no missed daily pivot today, but the strategy didn't really focus on the missed pivot on the day that you're seeing it getting missed. It was always, what did it mean for the next day? So when you would come in and look back at yesterday and say, oh, wow, look, it was a missed daily pivot. What's the weight of that? What's the connotation from that? And what do we do with it? If you don't know what those answers are, you could go to YouTube or Google and just type in missed daily pivot. You kind of pick up on it. I mention it often, and somebody asked me, what do I get out of mentioning it all the time if I don't trade it? I don't get anything for it, but traders tell me all the time they don't have strategies and they want a strategy, or they don't have, a background in doing analysis and they want to know where to pick it up. That kind of work comes from just learning one piece at a time. An MDP, a missed daily pivot, it's just another way to see the market. You pick up 100 different ways to see the market and start putting them together, you get a pretty good idea of what the market's doing and what you think it's going to do next. I don't trade that MDP, by the way. I just use it for analysis. 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. The low that you see wasn't the low when we made that pivot. So just kind of keep that in mind. Gone over that before. We dumped through that shallow area. The large volume shelf here didn't hold anything. We've cut through that as well. If we do break this Globex low or this low from yesterday, there's nothing really to help us out. And keep in mind, we've warned over the last, I don't know, 6 to 8 weeks that there's an inverse market or correlated market with the S&P. And when that product hits a support or hits a resistance and bounces, this does too. So we've been seeing bounces in the S&P where there was no pivot. We didn't hit anything with the S&P, and yet we bounced and we turned and we rallied. So if you're looking at the futures and the S&P just suddenly turns around and starts running and you're asking yourself, what the heck did we hit? I mean, you can look around and you might find something, but not always. And that's because maybe a market that's moving the ES hit a support or hit a resistance, and that market's reaction moved the S&P. It used to drive me crazy when I couldn't find what we hit. So, like this low down here, it kind of ties into this low back here, but that's an insignificant low. It's an insignificant pivot point. That's not enough to be a level of change structure. So why did we bounce on nothing yesterday? Well, I bet it wasn't nothing. I bet there was something down there. And if you don't find it, then it would be probably a correlated market. Well, I broke this one today. Actually, I think I broke it yesterday. All right, mapping out the 5x5. So we got a 5-day, 5-minute volume profile. We don't have an MDP or a VPOC or anything like that on this chart. The last VPOC is down here. It's a virgin point of control at 4,400. Long ways down. And the one above us is at 4,500. So we've got one about 100 points or on the roundies, 4,500, 4,400. And we're sitting at, 4,450-ish. So 50-50. Remember, those aren't support and resistance. They're just areas where we anticipate a reaction out of the market. And the weekly expected move. So yesterday I mentioned how the algos will trade this. They'll sell into selling or they'll buy into buying if we expand more than a 2 standard deviation. But that's on the week. Places like Spot Gamma will give you the day-to-day values. And if we cross through that value, that line in the sand, then we'll see them flip it and run it back up, or we'll see them dump it and just annihilate it. So we've seen that action before earlier in the week. Last week was a much better example, but this low down here on Wednesday where we flipped around and ran back up, that was a great example. But last week, here's one to the upside where we ran till lunch, and it was actually the distance that we would be concerned with. That's normally their line in the sand. Hey, we've moved to that limit. We're done. Leave it there. Then we would chop about to the end of the day, or we would flip around and come back. Instead, we had decision number 3. It kept going. We had a few of those to the downside. As beautiful and as nice looking as that is, we had ones to the downside in the last few weeks where it made the measured move for the day to the downside, consolidated there, and it looked like they were going to turn it around and run it back up. And instead, they dumped it and we kept going to the downside. So that day-to-day distance, if that's what you're looking for, you're going to find that through Spot Gamma levels. All right, the Spot Gamma website has those daily levels. Okay, what we're talking about is for the entire week. It's not so actionable on a day-to-day basis because you're talking about a 2 standard deviation for the entire week. And that can be, quite a range. And so it's take the entirety of the box and then you project that up. It's got to go at least that far for it to trigger into that buying into buying and selling into selling values, right? So you're going to want the one that's more actionable if you're trying to discern on a day-to-day basis where that line in the sand is of how far it should go before it's too far. What I like to do is just keep my eye on the clock, and that way I don't have to try to go in and discern that day-to-day measurement. And I've heard people say that 0.65 is just a nice not a nice number, but a consistent number. If you think back, how many times you've heard someone say 0.65 is the line in the sand of the S&P or the SPY, really to be specific. If the SPY moves 0.65, that's pretty much done right there. And that they're going to hold it there for the rest of the day. They'll reverse it there and come back, or will really start to go. And that's when you double the 0.65 and you start aiming for like 0.3, 0.35, maybe even 0.4 to really start to reach. So this move outside of that box this week, nowhere near the 2 standard deviation that we need to even imagine that they could have that selling or that activity. And today's the day where it all ends at the end of the day because they're only hedging their Friday to Friday position. Speaking of their Friday position, that's next week's range. It's not set in stone yet because today's not done. At 4:15 this afternoon, these lines are going to lock into place. And wherever they are at, that'll be next week's range. What we can do already, though, even though the range isn't set, is we can look at the week we just had, which was a short week, obviously. And we can lay it over next week's range. And we can ask, how much is the volatility going to increase? Now, to be fair, there's 5 days next week, and there was only 4 this week. So 1 extra day equals more volatility on the measurement of how far we could go. So this gap showing an increase here is very likely nothing more than just that added day that we didn't have. But the other thing that we can do, even though the week isn't done yet, is we can realize that, hey, we're outside of the box. Again, we're supposed to close inside that box 8 out of 10 weeks, or 80% of the time. If it's Facebook or Apple or Microsoft, then it's 7 out of 10. But when it comes to the S&P, this is special, right? Get that thing a helmet and some crayons. The S&P is special. It doesn't have a 70%. It has an 80%. And that's because it is the market. So it's got the most accurate expected move out of any product that you could ever trade. And its expected move accuracy is 80%. So it should stay in that box 8 out of 10 times. I can tell you right now that if we count back over the last 10 weeks, we did not close inside that box 8 out of 10. Nowhere near it. So what's it mean when we break out of that box and close outside once in a while? It doesn't mean anything. Once in a while, who cares? Nothing's going to be spot on, and 2 out of 10 isn't bad. But when it consistently breaks and closes outside that box again and again and again, one, it's saying the market makers are getting it wrong. They're not elevating that volatility to a level that's capturing the true move that we're getting in the market. Two, the volatility that we're seeing, the market isn't pricing it in. So we're getting these really big moves, but it's not equating it into the measurements. And where does the measurements come from? Is from the options. So the hedging isn't there, or the just flat out the trades aren't there to expand this range to capture the real volatility that we're seeing. It's usually a warning. Right before COVID hit, the S&P was sitting, near all-time highs, and we started breaking out of this box more and more and more right before everything went to hell and the world locked down and things went bad. So there was warnings. The skew levels were getting out of control. We were breaking outside and closing outside of the weekly expected move consistently again and again. And so there were warnings that, hey, something isn't right. And that's because those warnings for COVID itself were coming in from around the world, and it was slowly building up to be this bigger and bigger and bigger thing. So it was bleeding into the market early. All of these breakouts and closes below or outside of the weekly expected move is a warning that something's not right. So how do you use that? Well, if you're holding a bunch of stuff, really take a look at what you own. It's the common market theme, right? Know what you own. But ask yourself, are you comfortable with what you own seeing a 10% drop or a 5% rally? There's a thing called beta weighing where you can turn everything you own into SPY deltas, and then you can measure it against what your portfolio would look like if SPY moved 5% or 3% or 10%. And you'll know what the impact to your portfolio would be, even though you might be holding SPY, Apple, Microsoft, Google, stocks, options, a combination of all that. They'll just turn it all into SPY deltas. It's like comparing apples to apples instead of apples to Oreos. Something to think about. So we got a lot of warnings. The wall of worry's got a lot of bricks in it. It's not much of a surprise. There's always a lot of bricks in the wall of worry. We are at the 10-week. That's not a surprise either. We are there. Think of being at the 10-week as being in the middle of the football field or the basketball court. We're right in the center. The game starts here. We go up, we go down. We can move an easy 4% from here, up or down, and it wouldn't be overbought, and it wouldn't be oversold, and it wouldn't have moved too fast. So I'm not saying it owes us a 4% move. I'm saying we can move 4% from the 10-week moving average, and it still wouldn't be overbought or oversold because we're right in the middle of the court. We're underneath the 10-day by 0.5%, and that's nothing. That's That's fine. It might not look like we have a wave here, but this really is much like a wave. And we've completed that cycle where, we came through the wave over the top and now we're coming back through the bottom. A lot of times when we're just chopping about sideways, we'll just kind of wick up and down through the 10, back and forth, really not doing much. So that's kind of the expectation here. We need to drive away from that 10. And until we do, we're just chopping about it above and below, above and below. We're really not getting anywhere. And it's not support. It's not resistance. It's not helpful. It's not providing any insight at this point. It lost its flavor. That is really boring. There is nothing down enough to meet our criteria. There is nothing up enough to meet our criteria. This is a market looking to go into the weekend just happy to have survived without crashing and burning and having a completely nasty, ugly week. I really think the market's just going to try to hold its breath and go into the close without shaking the tree too much. The thing is, if they begin to fail in that, if it starts to unravel a little bit and begins to go, I think they just might throw up their hands and say, screw it, I'm done. So that we really want to watch that low that we were talking about. We can see that marijuana again is up this morning, but it's not really coming through as overly bullish. And we've got nat gas behind that, and then we've got Bitcoin, like BITO, suddenly just trying to wake up here. It looks really close to getting an inside day breakout, which would begin the move back to the upside. 1391 on BITO is the 50% kind of line in the sand. We measured that August 29 candle. So here's spot gamma. Zero gamma 44.59 on the SPX and 45.12, which 45.11 cog line for the ES. But if we go to SPY, it's 447. Now we got a volatility trigger at 445. And if these terms or phrases are unfamiliar to you, Spot Gamma's got YouTube videos. Even if you don't have a Spot Gamma account, their YouTube is free, right? Just go to YouTube, type in Spot Gamma volatility trigger or put wall or whatever one of these you're interested in getting a understanding on, and there's a video about it. They don't have, wall to wall 100% coverage of every single thing on their free YouTube, but they do have more of that information tucked into their, resources page and integrations and all that. I'm not trying to sell you on using these, but I mean, what is it? The mechanics always say, if you got the right tool, the job isn't that hard. Yeah. So one of the reasons I'm pausing here is because if you wanted a screenshot, this would be the time to do it, right? You take a screenshot of this and you copy those levels over to your chart. You want the cues? Okay. Zero gamma is 377. Volatility trigger is 374. Those were last updated yesterday, so we're early this morning. We'd want those levels to reflect today's values. If you want to hit me up later, I can, post the updated levels for you, throw them your direction. See, now SPY updated Friday, September 8th. That's relevant, but that Q is not. So just be careful with that. Always check the details, right? Says here, and this is today's, the Q's support remains at 370, resistance at 374. Looking at a market getting buoyed by a lack of volatility plus weekend, which translate into a light Vanna plus charm tailwind. So they're actually calling for the S&P to make a move to the upside today. Interestingly enough. I think we go into the close just trying to hold our head above water. They say there's enough tailwind in the optionality to actually give us a little lift. And for anybody eyeballing Apple, they're saying that that move only took it to an option spot that makes it a really good spot. So it's not negative. I mean, yeah, the share price is down. It's down like 6% on the week. So, yeah, it went down, but it's not crashing and burning at all. And all it did is take it down to that level before Jolts came out. And it found support at its largest gamma zone, at 175, 180, this red box right there. And it should hold into the next week's expiration. Remember, Apple has that Apple event next week. And they said put demand did not increase much. They see no reason for Apple to decline further over the next several sessions due to sticky gamma and a lack of downside demand. So, to be transparent, when I'm in positions and I'm analyzing a market, I always tell you guys, I'm in Apple. I bought common stock yesterday. I've had options on Apple for a while. They're basically free at this point. They paid themselves off. But the shares that I picked up yesterday was just the start of a new position. And it was because we were down, more than 5% yesterday. And I took advantage of it. I grabbed some Apple. I would have probably grabbed a little more if I'd have read that yesterday. And they have a little bit about NVIDIA, but look, there's a lot going on with NVIDIA outside of the chart, and I won't buy into NVIDIA shares anywhere near the levels that we're at. So if you haven't heard yet, you've probably been living in a cave, but there's something going on with some just the hint of some shenanigans with their book. And that is man, that's a blow, when you start questioning their books. It's like questioning somebody's integrity, like a doctor's integrity. They lose that, it doesn't matter if they're a good doctor or not. They won't get any patients. And the other pictures to catch would be right here, and I'll just leave it there for a moment. My 2 cents is take a picture once for this top one, and then take another one of that next one. Because if you try to capture them all at once, it's just this picture with tiny writing in it. They actually have these lines integrated into an indicator that if you have an account here, you can download the indicator every day with the updated levels. It's a bit annoying to have to go in every day and get the levels, but I mean, At least you don't have to sit there and draw the lines out all day or all morning. So we can see that 4,500 on the SPX. It's the largest optionality, at least to the upside. And 4,450 on the put side, to the downside. And we're looking at this stuff because there's nothing that has moved far enough for us to look at, right? Stock wise, if we're trying to look at what has moved this morning, pot stocks and nat gas and a little bit of Bitcoin. So in that direction, I guess we could go ahead and follow it down the rabbit hole. Precious metals are up a little bit and oil continues to be up. So silver, USO, the KWEB, the China ADRs, Bitcoin, so Riot, Mara, Coin, Hut, Hive, those kind of things, and pot stocks. That's not the backdrop for a rally in the S&P. But look, it can be the start, right? All we need is a spark. And a lot of times the catalyst that we get is nothing more than emotion-based sentiment anyways. So it might be the dash for trash junk first, but it can bleed over and then turn into a rising tide that lifts all boats if we start to get financials picking up behind energy. And then that starts to translate over into some old tech and then into some new tech. And then we get the fangs and we get this coordinated effort for a drive up with the optionality behind us, which we just read was a tailwind. We could see a rally today. So we got Riot here. That's not looking very bullish. Same thing with Mara. It tried, but it's already giving it back. Hut. Hive. Hive is still keeping it barely, but there's not much flows here. We can see the inside day breakout and it's already trying to come down and close that gap. For some penny stocks, BIOC is the one getting a lot of flow. Yeah, that's getting a lot of flow. Looking at it, we were down at like 83 cents and we hit nearly $1.40. That's not a bad move. Or Verb. Up this morning from, where was that thing yesterday? Like $1.60. You know, we went through 210. That's a pretty good size move. EOSC getting some flows, but it's really not translating much into stock price yet. But that's a 15-minute scoop. It'll turn into like a 15-minute cup and then maybe a handle, and just be careful with this stuff, right? It's not my forte. So on USO, It's not the same as XLE, right? XLE is broad energy. That can be all energy in XLE, from solar, wind, all over the place. USO, that's crude, it's oil. So your oil names and your oil ETFs, ETNs. One name that a lot of people were hitting on was Valero because of Buffett, right? Yeah, that's not doing anything good this morning. Or Chevron. You look at oil and gas with that XOP. That's up a little bit this morning. Nice gap up. See if it can stick. And it would be a nice continuation, right? If we look at here on the daily, we had a really good breather here for a little bit. Now we're kind of trying to take off again. We hit this big trend line and we were digesting it for a while. But man, look at those wicks on each side. So for this week, I think especially on XOP, it's just hold the line, make it through the end of the week, keep the head above water, and next week really try to, get some motion going. So just kind of keep that in mind. That's what I got for you guys. Be careful, be safe, have a good weekend. I'll see you all next week.